Imagine waking up to find that the fundamental rules of the global economy have shifted overnight, and the money in your pocket is suddenly playing by a completely different set of laws. For the past year, everyone, from Wall Street bankers to everyday consumers, was promised a light at the end of the tunnel. We were told interest rates were supposed to drop, mortgages were supposed to get cheaper, and running a business was supposed to get easier. But this past Wednesday, July 8th, 2026, that dream was completely shattered. The era of easy, cheap money? It's not coming back anytime soon. In fact, things are about to get significantly tighter. Under the bold and somewhat controversial leadership of the new Federal Reserve Chairman, Kevin Warsh, the central bank has just signaled a ruthless, uncompromising war on inflation. And listen, this isn't just a boring story for financial analysts in expensive suits. This is a massive, tectonic shift that will directly impact the cost of your groceries, the interest on your credit cards, the survival of local businesses, and the actual value of your hard-earned savings. So, let's cut through the financial jargon. Here is the unfiltered breakdown of what the Federal Reserve actually said this Wednesday, the hidden signals they just sent to the entire world, and, most importantly, whether this historic shift is a massive benefit or a disaster for the ordinary person. Let's start with the shockwave. What exactly happened on Wednesday? To truly understand the magnitude of this news, you have to understand the stage. The Federal Open Market Committee, or the FOMC, meets regularly to decide the fate of the US economy by setting the baseline interest rate. Think of this interest rate as the gravity for the entire financial world. Every single mortgage, auto loan, and credit card rate on the planet eventually adjusts based on what the Fed decides in that room. On Wednesday, the Fed released their detailed minutes, basically, the official, unfiltered notes of their mid-June meeting. And the entire financial world was holding its breath because this was the very first meeting led by the new Fed chair, Kevin Warsh. And they dropped a bombshell. First, the Fed voted unanimously to keep the baseline interest rate exactly where it is, sitting at a target range of 3.50 to 3.75%. But honestly, it wasn't the pause that shocked the market. It was the tone. It was the language they used. The Fed completely stripped away all of their usual comforting words about future rate cuts. There was no sugarcoating. Instead, they issued a blunt, aggressive statement, simply saying, "The committee will deliver price stability." If you speak central bank terminology, that is code for, "We do not care if we have to cause economic pain. We will crush inflation at all costs." And you might be asking, why? Why is the Fed suddenly so aggressive? Because the inflation nightmare we all thought was defeated is roaring back to life. The Fed's favorite metric for tracking inflation, called core PCE, spiked again in May. It is now sitting way above their comfortable 2% target. This isn't just a slight miscalculation. This is a massive red flag for the global economy. And then came the biggest shock of the day. The dot plot. Every quarter, Fed officials anonymously submit their predictions for where interest rates will go in the future. They put it on a chart called the dot plot. Before this Wednesday meeting, the market fully expected those dots to show rate cuts by the end of 2026. Instead, the Wednesday minutes revealed a stunning, violent reversal. 9 out of the 18 committee members now project that there will be at least one rate hike. Yes, a hike, before the end of this year. The entire conversation overnight shifted from "when will things get cheaper?" to "how much more expensive are they going to get?" And to add to the drama, Chairman Kevin Warsh refused to even submit his own projection for the dot plot. He just didn't do it. This breaks a tradition that has stood for over a decade. By refusing to play the prediction game, Warsh sent a chilling, crystal-clear message to the markets. The Fed is flying blind based on real-time data, and they are absolutely not going to trap themselves into making promises they can't keep. Now, let's step back for a second. What is actually driving this crisis? What are the massive forces pushing the Fed into such an aggressive corner? The Wednesday minutes highlighted two massive global engines driving up costs for everyone, everywhere. The first is the Middle East conflict and the price of oil. The sudden collapse of the ceasefire between the US and Iran has thrown global energy markets into absolute chaos. As geopolitical tensions rise, the threat to oil supply chains has pushed crude oil prices to dangerous highs. And here is the reality of the world. Oil is required to transport almost every physical good on Earth. When oil prices rise, the cost of literally everything else rises with it. From the cost of shipping inventory across the ocean to the cost of basic manufacturing. This geopolitical instability is acting like a massive, hidden tax on the entire global economy. The second driver of inflation is a lot more modern. It's the artificial intelligence energy drain. 2026 has been the year of the AI supercycle. But here is the thing no one talks about. The colossal data centers required to train and run these advanced AI models consume unprecedented, mind-boggling amounts of electricity. This sudden, massive surge in demand for power is straining global energy grids and driving up utility costs. The Fed specifically noted in their minutes that this AI-driven energy demand is keeping inflationary pressures uncomfortably high. When the Fed released these details, the market's reaction was violent. Billions of dollars moved in milliseconds. Stock markets tumbled immediately. Investors suddenly realized that companies are going to have to pay higher interest on their corporate debt for a much longer period. Higher borrowing costs simply mean lower profit margins. Wall Street hated it. Bond yields spiked. The yield on the 2-year US Treasury bond shot up. And when bond yields rise, it sucks money out of riskier investments, because investors realize they can get a guaranteed, high return straight from the government. Gold and silver crashed. Because higher interest rates make the US dollar stronger, commodities that priced in dollars, like precious metals, saw massive, aggressive sell-offs. Even Bitcoin trembled. Cryptocurrency thrives on cheap money and high liquidity. Bitcoin was on a strong recovery path, but the sudden realization that rate cuts aren't coming anytime soon caused a sharp pullback across the entire crypto market. But let's bring this all back to reality. Let's bring this back to you. Does this high-level macroeconomic chess game actually matter to the ordinary person? Does this news bring any faida, any benefit? Or is it purely a nuksan, a massive loss? The brutal truth is that a high interest rate environment acts as a double-edged sword, but the blade facing the average consumer is significantly sharper. Let's talk about the pain points first. Let's talk about the nuksan. For the vast majority of people, the Fed's decision to keep rates high is just plain bad news. It restricts your cash flow, it stifles economic growth, and it makes daily life more expensive. First, there is the crushing weight of borrowing. If you carry a balance on a credit card, if you are looking for a car loan, or if you are trying to secure a mortgage for a house, you are the one paying the price for the Fed's war on inflation. Credit card rates will remain at punishing, near-record highs. Mortgages will remain incredibly expensive, effectively locking young families out of the housing market entirely. The dream of refinancing your home to a lower rate? That dream is dead for the foreseeable future. Second, think about the squeeze on local businesses and independent entrepreneurs. Imagine you are the owner of a local retail business. Maybe you run a shop specializing in imported and stitched fabrics and premium branded suits. Running a physical shop means you constantly have to buy inventory. Often, business owners use short-term credit to purchase this inventory before selling it to their customers. But when the Fed keeps interest rates high, the cost of financing that fabric inventory increases dramatically. As a business owner, you are forced into a terrible corner. You either have to absorb that extra cost and take a massive hit to your own profit margins, or you have to raise your prices, risking the loss of your loyal, everyday customers. Third, there is a massive premium on technology and creative pursuits. High US interest rates make the US dollar incredibly strong compared to other global currencies. If you live outside the US, or if you rely on imported electronic goods, this is a nightmare scenario. Let's say you are a media creator. You want to upgrade your studio to a high-end setup to get that perfect cinematic look. You are looking at a flagship Sony A1 mirrorless camera, paired with a premium 85mm f1.4 lens. The strong dollar, combined with supply chain inflation, can push the prices of that specific hardware astronomically high. High rates make technological upgrades painfully expensive for freelance creators and small production studios. Fourth, even practical, money-saving home projects are severely impacted. Imagine you are planning to install a residential solar energy system to fight off your rising electricity bills. Maybe you live in a mountainous region with high winds, so you need a heavy-duty system with specialized wind-resistant stands and high-capacity battery inverters. The upfront capital required to buy all that solar hardware is huge. If you need to finance that project with a loan, the high interest rates will completely eat away at the long-term savings those solar panels were supposed to provide in the first place. So yes, the pain is real. The nuksan is everywhere. But it is not all doom and gloom. There is a silver lining. There actually is a faida to all of this, if you know where to look. While the overall economic environment is tough, there is a specific type of person who actually benefits from Kevin Warsh's aggressive policies. the disciplined saver and the cash-rich investor. We are officially entering the golden era for savers. For the last decade, keeping your money in a traditional savings account was basically a guaranteed way to lose wealth. Inflation completely outpaced the tiny fraction of a percent banks were paying you. But that era is over. Because the Fed is keeping the baseline rate so high, ordinary people can now access high-yield savings accounts, certificates of deposit, and government bonds that pay substantial, absolutely guaranteed returns. If you have cash sitting on the sidelines, the current environment allows you to generate a safe, predictable yield without taking on the terrifying, volatile risks of the stock market or the crypto market. Another massive benefit? The Fed is putting a check on runaway asset bubbles. By refusing to cut rates, the Fed is preventing the economy from entering a dangerous, speculative bubble. When money becomes too cheap, investors throw cash at terrible ideas, driving the prices of housing and stocks to completely unsustainable, crazy levels. By keeping money expensive, the Fed forces the market to act rationally. It ensures that only solid, profitable businesses survive, and it attempts to prevent the cost of housing from inflating even faster than it already has. And finally, the ultimate benefit to the ordinary person is the long-term goal of this entire policy: crushing the hidden tax of inflation. Inflation is a regressive, silent thief that disproportionately hurts the working and middle classes. When the cost of food, fuel, and clothing rises by 5% a year, wages almost never keep up. By forcing us to take the bitter, painful medicine of high interest rates right now, the Fed is desperately trying to stabilize prices so that your hard-earned paycheck actually retains its purchasing power next year and the year after that. So, how do you navigate this financial landscape in 2026? How do you survive, and even thrive, in an economy where the Federal Reserve is aggressively prioritizing price stability over everything else? First, you must audit your debt immediately. Variable rate debt is a financial death sentence in 2026. Because the dot plot shows that rates might actually go up, anyone with an adjustable rate mortgage, high credit card balances, or variable business loans needs to act right now. Aggressively pay down this debt, or consolidate it into a fixed rate structure before it's too late. Second, pivot to cash flow generating assets. Speculation is out. Durable yield is in. With the cost of capital remaining this high, investments that don't produce actual, tangible cash flow are going to struggle. Whether it is rotating your portfolio into dividend-paying stocks, taking advantage of fixed-income government bonds, or investing in the physical infrastructure of the AI boom, your money needs to be anchored in reality, not hype. And third, if you are a business owner or a freelancer, this is the time to optimize your efficiency. The businesses that survive the Kevin Warsh era of the Federal Reserve will be the ones with immaculate data tracking, tight inventory management, and low overhead costs. You can no longer rely on cheap loans to cover up inefficient business models. You have to be lean, and you have to be smart. The bottom line is this: the news from the Federal Reserve this past Wednesday was a stark, freezing cold wake-up call. The financial world was hoping for a pivot. We were hoping for a rescue. We wanted a return to the easy days. Instead, Chairman Kevin Warsh delivered a heavy dose of reality. The inflation fight is far from over. The economic turbulence caused by global conflicts and the massive AI energy drain means that interest rates will act as a heavy anchor on the economy for the rest of 2026. For the ordinary person, this means bracing for impact. Borrowing is going to remain painful. Large purchases will require careful, meticulous planning. But for those who are prepared, those who have managed their debt and have cash ready to deploy, this environment offers some of the best guaranteed returns we have seen in modern history. The rules of the game have fundamentally changed. And the winners will be those who adapt the fastest.